and welcome to Blytheweigh Business News. I am Bonnie Hughes. Our guest today is Caledonia Mining. They consistently pay a dividend, which has got a yield of about 4.6%. They've consistently produced and generated revenue, and they are on track for increasing production. And here to tell us all about the company is Mark Learmonth, Chief Financial Officer. Hello, Mark, and thank you very much for joining us.
Thanks for having me here again.
So you're one of the few mining companies that consistently pay a dividend, which the market very much likes.
Yeah, we do. Every quarter. We've done it for about 5 years now, and it's a very important factor to differentiate ourselves from the other gold producers. But also we recognise that whilst the mine is a very attractive asset, is in a somewhat challenged jurisdiction, which I think we're probably going to talk about. And frankly, you know, we have to pay the quarterly dividend, because we can afford it, and it's a good discipline for management, I think. But just to remind investors that we're still there, we're still in business. And one of the things I think we're going to talk about is what's happening sort of economically in Zimbabwe at the moment, particularly the difficulty extracting foreign exchange. And you know, we've been very transparent about the fact that by paying the dividend, we are proving that we are getting access to the foreign exchange, and we are therefore in a position to pay the dividend. So it's a sign of life, effectively. It's a sign of life. We're still here. We're still here. Those pesky dividend checks that you get every quarter proves we're still alive.
And you consistently sell your gold to the government.
We do. We sell the gold to the government. We've been doing that for many years now. And it's actually worked quite well for us, because previously we used to export our own gold. Initially we went through to South Africa, which was quite close, but we had difficulties around refinery, and then eventually we ended up selling our gold through Switzerland, and sometimes our gold has got arsenic in it, and an individual bar could sort of move around the world until they found somewhere that was able to deal with this arsenic content. And so you could end up being sort of waiting sort of many weeks, even months, for this thing to get processed and paid. So we're selling to government, we deliver on a day, and we get paid sort of 2 or 3 days afterwards at the London price, less an early settlement discount, which is very small, before they've even smelted. So that works very well for us. We're not concerned about that at all. That works very well for us.
And the change in government in Zimbabwe has been, sort of a bit more beneficial for the country and more positive for business?
I think that's really what we need to talk about. The government changed sort of last year, 18 months or so ago. Mugabe left. There was a very popular sort of uprising. More people than anybody had ever imagined took to the streets of Harare to celebrate Mugabe's departure. The new president is Emmerson Mnangagwa, who's been there for quite some time. Very different sort of character, whereas Mugabe was a very sort of populistic politician. Mnangagwa was a bit more reserved, but the fundamental difference between the two, which we've picked up, and we've met Mnangagwa many times, both myself and Steve Curtis, the chief executive, is Mnangagwa and his team of senior cabinet ministers are absolutely focused on trying to get Zimbabwe from the mess it's in to a better place. And there's two key elements to that. The first is desperately trying to stimulate economic activity, bona fide real proper commercial economic activity on proper commercial basis. And so absolute focus and commitment to growing the mining industry, rehabilitating agriculture. Those are probably the two most important strands of trying to get that economy going in. But the other thing that he's trying to do, which I think is probably behind some of the very unpleasant and very disturbing pictures that we've seen on our TV screens over the last few weeks, is now trying to make sure that Zimbabwe as a country lives within its means. So Zimbabwe doesn't have its own currency. It can only, if it wants to import diesel and electricity and pharmaceuticals and fancy cars and that sort of stuff, it can only get the foreign exchange to pay for that stuff by exporting stuff like gold. It can't print more money, it can't borrow money. And so one of the things that's been causing a lot of distress, I think, on the ground in Zimbabwe is the government's now trying to run a balanced budget. It's only spending what it's earning, and it's having to scale back on this sort of profligate spending of dollars which they don't have. And that's given rise to higher taxes, which came in just before Christmas, and it's given rise also to increases in things like the fuel price. which has caused a lot of distress for people. It's part of, I'm afraid, it would appear to be part of a coordinated and concerted attempt by government to get that economy back onto a more virtuous track. But it's going to be very painful, trying to unwind decades and decades of economic mismanagement. You can't do it overnight, and there's no silver bullet for this, I'm afraid. So a lot of sympathy for the people in Zimbabwe, but a recognition that for them to get to a better place, which I'm sure they do want to get to, is going to be a painful exercise, I'm afraid.
And are they trying to encourage more foreign investment into the country?
Very much so. They are trying to encourage foreign investment, but the tragedy is that the events that we've seen playing out, protesters being beaten on the streets by policemen, kind of goes against that. So, unfortunately, whatever goodwill the new government had would appear to have been dissipated, unfortunately, over the course of the last sort of few weeks, which is a real shame. But the conditions on the ground are stable. The borders haven't closed. We're still managing to import the stuff we need to import to keep the mine going. Whilst there was the general, it wasn't quite a general strike, but there was a very well organised stay away from work. During that period, the banks weren't operating properly, so there were delays in receiving and making payments. But that's all now sorted out. So, whilst the environment, I've got to say, is a little bit tense, and people are disconsolate, I think is the best way to say it, disconsolate and apprehensive, and they're suffering through higher taxes and higher prices. Things are working again, and we've not had any interruptions to production, which sounds a little bit callous to say, oh, we're all right, but I don't want people to think that the underlying operation has been adversely affected by what we've been seeing on the television screens.
And obviously your production update that you put out last month showed that you're consistently doing your production and achieving your production. Yeah,
now let's be clear, where we are at the moment is very much sort of an interim phase. The big thing we're doing is sinking a new shaft, it's called the central shaft, going from surface to about 1,250 metres below surface. We're pretty much nearly there in terms of sinking. We're now doing some horizontal development, a little bit further to sink, we're doing horizontal development. That'll be commissioned in 2020. And until that shaft is commissioned, and we're not going to see a significant increase in production to probably 2021. So between now and then, we're pretty much going to continue at about the same level that we achieved in 2018, sort of mid 50,000 ounces a year, at which level we make good money. When we increase production to 80,000 ounces from 2021 onwards, the cash dynamics of this business change enormously. The incremental production with a very low marginal cost of every extra ounce costs us very little to produce. So our cash generation goes up, our capex goes down, so we have a very significant increase in free cash flow, which we can use to evaluate further investment opportunities, both at the mine and off the mine, and obviously reward shareholders, which is, as a shareholder myself, I think the shareholders should come somewhere towards the front of the queue when it comes to that analysis.
Oh yes, you did put out an announcement near the end of last year that directors actually purchased more stock, which is always good.
Directors purchased more stock, and also we, Steve and myself, and some of the other management, we benefit from a long-term incentive scheme, which has manifested for Steve in Steve Curtis, the chief executive, getting a dollop of shares recently. Because I was moving out of South Africa, the timing of my awards was slightly different to Steve's. I got a small dollop in January, and I'll get another dollop in March. But yes, the chief executive and the CFO are heavily invested and very, very much incentivized, and we've got goal congruence. I hate that phrase, but goal congruence with regular investors.
So you're looking at other opportunities in Zimbabwe, so you must have some confidence in the future of the country.
We do. We've got great confidence in the future of the country, because underlying the whole thing is the quality of the people in Zimbabwe, which is just extraordinarily good. So that's a differentiating factor between Zimbabwe and other sub-Saharan countries you might want to look at. The geological prospectivity of Zimbabwe is fantastic. So those are the two big things. Those are the two really important things. Unfortunately, when it comes to evaluating opportunities, the immediate geological data that's presented to you can be somewhat iffy. The legal due diligence is a complete mess. People say they own it, but they can't prove it. The licenses and the leases, they're all over the place. Financially, many of these things are very, very challenged. They owe a lot of money. To some extent, operationally, they've been cannibalized. So there's some great things to look at, but when it comes actually to to unpacking it and actually finding an asset and then agreeing a price, it becomes very difficult. But we continue to look at opportunities in Zimbabwe, and there's some great things to look at.
And what about artisanal mining? That seems to be a big thing in Zimbabwe as well.
Yeah, the previous government did encourage artisanal mining as a way of, I think, perhaps keeping people busy. And there has been a genuine increase in gold production and hence gold exports as a result of artisanal mining. It doesn't affect us in the slightest. Artisanal, you got to not confuse what's artisanal mining in Zimbabwe is basically a bunch of guys turning over the top sort of 6 feet of soil and finding other small nuggets or bits of ore which then go to a stamp mill. They don't start entering old workings or current workings, which is typically what happens in South Africa. So artisanal miners don't cause us any difficulty unless they start damaging infrastructure, like trying to mine underneath roads or something, in which case the police close them down quite quickly. So yes, there has been an increase in artisanal mining, but it's not a challenge or a threat, and it doesn't impede certainly doesn't impede our operations.
And your current shaft sinking is being financed by a hedging agreement that you put in place.
No, it's been financed by our organic cash flows. So we generate, say, $25 million a year, and a good proportion of that gets spent on capex. And the major element of that is the sinking of the central shaft. The amount we're spending compared to the amount we're spending is very nearly the same as the amount we earn. So until we start to increase production, it's quite tight. Certainly this year is quite tight, and so we took advantage of the opportunity to put in place a hedge to guarantee a minimum gold price. So it's not a forward sale. Okay, all we did is we bought out of the money gold put options, which means if the gold price falls below $12.50, those bits of paper have some value. It's by no means a forward sale. So at the current gold price of over $1,300, we benefit from that completely. So please don't think that we've sort of given away any upside potential of the gold price. We haven't. It was just like an insurance policy to allow us to lock in a minimum gold price of $12.50. I think for about six months. So we're now down to about 5 months, and we'll look at renewing that certainly over the course, push it out perhaps to the end of the year. But in the ordinary course of events, as we've increased production and we've got our capex down, so much stronger cash flows, we wouldn't need to hedge. We wouldn't need to do it at all.
Excellent. Well, thank you very much for joining us, Mark. And we look forward to meeting with you again and hearing about the progress of the shaft sinking and possibly an acquisition in the future. Thank you very much, and thank you for joining us on Blytheweigh Business News. Have a very profitable day.